5 companies control over 90% of a chip market worth $10 billion by 2030. One of them just went bankrupt. The other 4 are fighting over the wreckage. This is silicon carbide, the material reshaping how the world moves, charges, and powers artificial intelligence. And the American company that bet everything on it watched its stock fall from $142 to 39 cents. In this episode, we'll answer 3 questions. First, how did a U.S. semiconductor pioneer burn through $6.7 billion and end up in bankruptcy court? Second, why is this chip 3 times more expensive than silicon and why it may never be cheap? Third, among the handful of stocks you can actually trade on this theme, who wins the $10 billion SiC war and what does China's rising capacity mean for American companies leading the charge? Let's start with the basics. Silicon carbide is a compound semiconductor, silicon bonded with carbon at extreme temperatures. Compared to regular silicon, SiC handles 3 times the voltage, operates above 200 degrees Celsius, and wastes far less energy as heat. Now, you might ask, what about gallium nitride? GaN is excellent for low-power, high-frequency applications like phone chargers and laptop adapters. But when you need to handle thousands of volts and hundreds of amps, the kind of power inside an EV drivetrain or a grid-scale inverter, silicon carbide is the only game in town. SiC handles extreme conditions that gallium nitride simply cannot. That's why every major automaker building 800-volt EV platforms is betting on it. And the market knows it. The EV sector alone accounts for 70% of SiC demand. Add solar inverters, data center power supplies, and grid infrastructure, and you're looking at a market projected to reach $10 billion by 2030, growing at 20% annually. Now, the company that started it all. Cree was founded in 1987 in Durham, North Carolina, 6 graduates from NC State who figured out how to grow silicon carbide crystals. For 30 years, Cree was known for LED lighting. Then in 2017, CEO Greg Lowe arrived with a radical bet: sell the LED business, rename to Wolfspeed, and go all in on SiC power chips. By November 2021, the stock hit $142. Wolfspeed opened the world's first 200mm SiC fab in Mohawk Valley, New York, a $1.2 billion facility. The U.S. government backed it with $750 million in CHIPS Act funding. Apollo led another $750 million. The vision was clear: own the entire SiC supply chain, from crystal to chip. Nobody had ever tried that at this scale. But building a cutting-edge fab is not the same as running one profitably. Mohawk Valley ramped slower than expected. Yields were low. EV demand softened. And the debt was staggering. By early 2025, Wolfspeed owed $6.7 billion. Gross margins turned deeply negative. The stock fell below $1. On June 30, 2025, Wolfspeed filed for Chapter 11 bankruptcy. It emerged 91 days later, one of the fastest restructurings in semiconductor history. But the damage was done: $4.6 billion in debt eliminated, original shareholders received just 3 to 5% of the new equity. A near-total wipeout. In my view, Wolfspeed's fall is the defining cautionary tale of this industry. Being first doesn't mean being profitable. Vertical integration only works if every link in the chain makes money. Here's the question everyone asks: will SiC ever be as cheap as silicon? The short answer is no. A silicon carbide MOSFET costs roughly 3 times more than an equivalent silicon IGBT, as of early 2026. And the reason is structural. Growing a SiC crystal takes 7 to 10 days, silicon takes hours. SiC substrates cost 30 to 50 times more than silicon wafers. Yield rates for power-grade wafers remain below 70%. So why bother? Because total system cost tells a different story. SiC cuts energy losses by up to 30% in EV powertrains, smaller batteries, lighter vehicles, longer range. For an 800-volt EV architecture, the savings downstream more than justify the premium upstream. That's why every major automaker, from Tesla to BYD to Hyundai, has adopted SiC in their high-end platforms. Silicon carbide will never be cheap. But it doesn't have to be. If SiC can't match silicon on material cost, the industry's best lever is wafer size. Moving from 150mm to 200mm wafers increases chip output per wafer by roughly 80%. 2026 is the transition year. Wolfspeed shut down its 150mm Durham fab, fully committed to 200mm at Mohawk Valley. Infineon is ramping Kulim Module 3 in Malaysia. Onsemi became one of the first to mass-produce SiC on 200mm in 2025. But here's the tension: the 200mm transition demands massive capital, and it's happening during an overcapacity downturn. Companies are spending billions on capacity that won't be fully utilized until 2028. It's a bet on the future. Not everyone can afford to make it. And for those who can't, the window is closing. Let's look at who controls this market and which names you can actually trade. 5 companies hold over 90% of global SiC power device revenue. STMicroelectronics held 32.6% market share as of 2023, the largest single player. Onsemi followed at 23.6%. Infineon at 16.5%. Wolfspeed at approximately 10%. And ROHM at roughly 8%. For US investors, the most liquid plays are clear. STM trades on the NYSE. Onsemi, ticker ON, is on NASDAQ. Wolfspeed, a ticker Wolf, is also NYSE listed. Infineon and ROHM trade over the counter. The total SiC power device market reached approximately $2.7 billion in 2025. By 2030, the target is $10 billion. The race is on. Among US-listed SiC plays, Onsemi is arguably the strongest hand. Onsemi, headquartered in Scottsdale, Arizona, serves over 600 SiC customers globally. It achieved 200mm mass production in 2025. At the Shanghai Auto Show, Onsemi products were featured in 50% of all new EV models. AI data center power revenue doubled year over year. And the company generated $1.4 billion in free cash flow in 2025, returning 100% to shareholders through buybacks. Then there's STMicroelectronics, European headquartered but NYSE listed. ST generated roughly $1.1 billion in SiC revenue in 2024, drawing on its 32.6% market share position. But 2025 was painful, margins compressed to 29%, and a key European EV customer delayed programs. Their hedge against China? A joint venture with Sanan Optoelectronics, targeting 480,000 8-inch SiC wafers per year. Both are profitable, both scaling, both locked into long-term automotive contracts. For investors, that's the moat that matters. For US investors looking for a pure-play SiC bet, Wolfspeed is the only option, and it's a roller coaster. Post-bankruptcy, $1.3 billion in cash, debt slashed 70%. But the latest quarter delivered just $168 million in revenue with negative 34% gross margins. The irony? Wolfspeed still holds 33.7% of the global SiC substrate market, the most valuable upstream position in the industry. The Mohawk Valley fab is one of America's most strategically important semiconductor assets. The question is whether the business survives long enough to monetize it. Overseas, the field is deep. Infineon, Germany-based, OTC in the US exceeded €500 million in SiC revenue in fiscal 2025 and is targeting €1.5 billion in total power solutions for AI data centers by fiscal 2026. Japan's ROHM launched 5th-generation SiC MOSFETs in 2025, targeting 30% market share by fiscal 2027, that would mean tripling its position in 3 years. Now the part that keeps American semiconductor executives and Washington awake at night. Chinese companies now control approximately 40% of global SiC wafer and epi wafer installed capacity, as of 2024, though actual utilized production is lower, as many fabs are still ramping. In the substrate market, the shift is dramatic. Wolfspeed still leads with 33.7%, but China's Tanku and SiC have surged to 17.3% and 17.1%, second and third globally. Both are scaling to 200 millimeters. Over 15 SiC fabs are active or under construction in China, with cumulative investment exceeding $12 billion. For US companies, this is a two-front war. On one side, Chinese competition is compressing prices across the board. On the other, the CHIPS Act was supposed to strengthen domestic production, but its biggest SiC recipient just went through bankruptcy. ST's joint venture with Sanan is a pragmatic hedge, but it also moves critical know-how closer to Chinese manufacturing. For Wolfspeed and Onsemi, the question is whether US policy support can keep pace with China's scale. Here's the uncomfortable truth. The SiC industry invested as if demand were already at 2030 levels. It's still 2026. Upstream utilization rates sit at roughly 50%. Device lines run at about 70%. According to Yole Group, this overcapacity downturn will persist until 2027 or 2028. And there's a deeper risk. SiC depends on EVs for 70% of its demand. If global EV adoption stalls, whether from subsidy cuts, charging infrastructure gaps, or consumer hesitation, the entire demand story shifts. That doesn't kill SiC, but it stretches the overcapacity cycle by years. Who survives? Companies with vertical integration, locked-in automotive contracts, and a balance sheet to weather the storm. That favors ST, Onsemi, and Infineon. Who's at risk? Undifferentiated substrate makers, subscale fabs, and if margins stay negative, Wolfspeed. The market will reach $10 billion by 2030. But between now and then, there will be casualties. So what happens next? The most likely path over the next 1 to 2 years, overcapacity persists through 2027. I give it a 60% probability that we see the first major SiC consolidation and acquisition or merger by late 2026 or early 2027. Watch these 3 signals. First, Wolfspeed's gross margin. If it turns positive by mid-2027, the company survives. If not, a second restructuring becomes likely. Second, 200mm yield rates crossing 80%, that's the threshold where economics fundamentally shift. Third, Chinese SiC device market share. When it exceeds 20%, the pricing pressure becomes irreversible. On catalysts, upside from 800-volt EV adoption accelerating, AI data center power demand surging, and continued CHIPS Act support for domestic SiC manufacturing. Downside from a global EV slowdown, aggressive Chinese price wars, or policy uncertainty. Looking at the supply chain, upstream, substrate makers face consolidation risk, especially those without their own device business. Downstream, every EV maker, solar installer, and data center operator benefits from falling SiC prices. For U.S. investors, the clearest plays remain Onsemi for stability and Wolfspeed for a high-risk turnaround bet. The pain is concentrated at the top of the supply chain. The value flows to the bottom. I'm Big Z, follow me, see you in the next deep dive.